Kerry Martin here. So having said that, though, I mean, the two moves that I just talked about that the G7 is working on to ban exports to China and also to restrict flow of foreign direct investment into China even further. If that were to come to pass, I think it'd be fair to say that would ratchet tensions up even higher. One, disrupt supply chains even further. What are markets going to make of that? Or rather, what do you think the chances are of success of that happening? Because, as I suggested a couple of minutes ago, the EU as well as Japan are not quite on board with this idea, which is being initiated, of course, by the U.S.
Yeah, it comes back to this idea of where this multipolar world, how much the US influence is having on other economies to try and achieve their strategic objectives. And I think in some regards, they're a little bit out of sync with what the rest of the world wants. And again, as we head towards the US election in 2024, I think you're going to hear more of this China rhetoric come through in terms of deflecting away from domestic issues. But also there's a strong base in the US that still sees China as a bit of an issue in terms of what it's doing to the US economy and perhaps blaming some of them. So I wouldn't expect that rhetoric to go away. And again, I think it does come back down to the materiality of what some of these announcements actually say and then versus what's actually implemented. For us, it's really a case of thinking about the ramifications of this globally being one of, could this lead to be more inflationary if you do see supply chains that have to be more resilient? Is there going to be some reshoring of certain productions to the US? I do think a lot of that has actually started to come through already. And so it's not going to become this massive shift that markets have to adjust to, where it's something they've been contemplating for a while now.
Kerry, talk to us about the unimaginable. And by that, I mean the risk or threat, which is becoming, I think, more evident by the day of a U.S. debt default. I talked about how CDS is right now our price probably the highest since 08, 09, especially the spread compared to a one-year U.S. paper. So somebody surely is concerned about that. I mean, this is at a time when G7 finance leaders are talking about maintaining financial stability, anchoring inflationary expectations, managing price pressures as well. If this were to happen, it would be the first time in history. I mean, yields would go through the roof, would they not? This would be an awful time for it to happen.
Yeah, I mean, it's something we refer to as an unwanted distraction, given everything else that's happening in the global economy, the concerns around inflation, as you mentioned, the concerns around the growth outlook in the US and elsewhere in the world. So maybe it was omitted from the final communique from the G7 ministers because it's something that could actually be resolved very quickly if both parties can agree. And I know there are those negotiations that have been delayed. And that's because, we can look back across the history of the debt ceiling and illustrate to say that in times it has been an issue. We've had the default, we've had the government shutdown in 2011 and 2013, but for over 100 years, the debt ceiling's been in place and it's usually been moved or just extended. So there is a high chance that happens again. The pressure really comes at a time when we're thinking about added volatility to the market from this political brinkmanship when we do have a Federal Reserve that's contemplating whether it's done with interest rate hikes. We have a lot of momentum coming out of the US economy and thinking about a recession. So it just really adds to that specter of seeing another downward leg for the US economy. And as you mentioned, I think if there was a genuine issue with the debt ceiling being breached and not being extended, if we did see potentially a default or even a government shutdown, I mean, the risk-off move would really see yields fall in that environment, probably the dollar fall as well. So we wouldn't think about it being something where suddenly a credit premium or a risk premium is built into US Treasury yields. It would very much be the opposite for us. And that's what happened the last two times this has really been an issue for the US economy.